Imagine this. You check your credit score one day, and it's 750. Everything looks perfect. Your payments are on time. Your accounts are active. And financially, things seem to be going well. But then something strange happens. Your credit score suddenly drops. Maybe 50 points. Maybe even 70 points. And the confusing part is, you didn't miss a single payment. So what actually happened? There is one hidden factor that banks watch very closely. It's called credit utilization. And if you don't understand how it works, it can quietly damage your credit score, even when you're doing everything else right. Let's break it down in simple terms. Credit utilization simply means how much of your available credit you are using. Think of it like this. If your credit card has a $1,000 limit and you spend $300, then your credit utilization is 30%. It's just a simple calculation. The amount of credit you're using divided by your total credit limit. But this number matters more than most people realize because lenders use it to understand how dependent you are on credit. If you're using too much of your limit, it signals risk, even if you always pay on time. That's why financial experts recommend following what's called the 30% rule. This rule is simple. Try to keep your credit utilization below 30% of your total limit. So if your credit limit is $1,000, your balance should ideally stay under $300. But if you want an excellent credit score, experts recommend aiming even lower. Many people with very high credit scores keep their utilization under 10%. That means if your limit is $2,000, your balance should stay below $200. Why does this matter so much? Because high utilization makes lenders nervous. For example, if your credit limit is $1,000 and your balance is $900, that means your utilization is 90%. To banks, that looks risky. It can signal that someone may be over-relying on credit. And that's why your credit score can drop quickly when utilization becomes too high, even if you've never missed a payment. But the good news is, this is one of the easiest parts of your credit score to fix. Here are 3 simple ways to lower your utilization. First, try to pay your credit card balance early, instead of waiting until the due date. Pay part of the balance before the statement closes. This helps a lower balance get reported to the credit bureaus. Second, consider asking your bank for a credit limit increase. If your limit increases, but your spending stays the same, your utilization automatically drops. Third, if you have multiple credit cards, avoid putting all your spending on just one card. Spread your purchases across several cards. This keeps the utilization lower on each account. At the end of the day, credit utilization is a simple rule to remember. Below 30% is good. Below 10% is excellent. Follow this rule consistently, and banks will see you as a low-risk borrower. And that can lead to better opportunities like higher credit limits, lower interest rates, and easier loan approvals in the future. If you want to build strong credit, understanding this one rule can make a huge difference. And now I want to ask you something. Do you know your current credit utilization? Take a moment and check it, because sometimes a small change in this number can make a big difference in your credit score.